Nigeria's Monetary Policy Committee voted to keep all policy parameters unchanged, including the benchmark interest rate at 11.5% at its third meeting earlier today. I was joined earlier for a post-MPC announcement analysis by Bismarck Rewane, the CEO of Financial Derivatives, a member of the Presidential Economic Advisory Council, Gregory Kronsten, Head of Macro and Fixed Income Research at FBNQuest, Mohamed Abu Basha, the Director and Head of Macroeconomic Research at EFG Hermes, and Chamberlain Peterside, CEO of Xcellon Capital Advisors.
Well, I mean, if I had to pick one point, I'll pick up the diaspora bonds. I don't know if that'd be everybody else's choice. Well, this is quite interesting, I think, because they tried one about 5 years ago, I think. And the signal after that from the ministry and also the DMO was that they weren't in a rush to repeat the exercise. But what we've seen, of course, is the remittances issue, or at least how it's hit Nigeria, not all jurisdictions, but Nigeria big time. And, central banks, other jurisdictions, as well as trying to attract remittances with incentives, which is what Nigeria is now doing with the Naira $4, but also they have other sovereign instruments for sale, and like Pakistan or Bangladesh or many other examples. So for me, that's probably the most interesting thing. The starting point, of course, is what's the demand like, and that they have to test the waters. So that's the one I would choose. I mean, on the rate itself, no change, but nobody expected any change.
Sure.
And frankly, if inflation doesn't move very much, and GDP doesn't move too much, it'll be no change next time as well.
I think that's widely expected. But Bismarck, if you can just comment on this, one takeaway for me was the MPC acknowledging the very fragile recovery. However, one of the policy measures that they seem to support is forex restrictions to support local manufacturing of previously imported products. Now, that obviously has been a bit of a controversial policy, but I wanted to get your take on that as a way forward to manage some of the challenges we're facing now.
It's a bit contradictory in the sense that you want to open up the economy, you want investments to come in, you ratify the African Continental Free Trade Agreement. Therefore, I think restrictions should be downplayed for now. It's in the long term, self-sufficiency is a good goal, but at this point in time, just to get the recovery up and going, you need to do two things: reduce the restrictions, fund the forex market aggressively, and that way inflation comes down. He alluded to the fact that there was some good moves on manufacturing, but I think that one other sector that is very important in terms of employability is trade. Traders and trading sector actually contracted, even though we opened our borders in Q1. So I think trading is a function of one, credit, two, forex availability, and three, liberalization of the environment. So I think that is what we need to see. But generally speaking, I think it was a good communique. I think they're very frank and candid about what the true position is. But then we now need to, this is the time for the heavy lifting, because if you don't get growth rates above 4 or 5% next quarter, which I think it will happen because the second quarter of 2020, we had a contraction of -6. So the base year effects are going to make the second quarter of 2021 much better, right? And therefore, you will see that. But to achieve the 2.5% growth projected by the IMF, this economy needs to grow at 3%, 3.2% throughout this for the next 3 quarters to make up for the disappointing Q1 numbers.
Right. Chamberlain, if you can speak to the point about intervention funds, and the central bank governor more or less read out a report card in terms of how that is working out. Again, that has been a bit of a controversial subject in Nigeria, but do you think this is one of those things that we simply have to expect from the central bank in its, as I think Gregory put it, its development finance type role that it seems to have to play in these times?
Yes, Wole. obviously, over the years, we've seen central bank assume that responsibility of almost midwifing the economy to growth. So these intervention funds, they have been handy, quite frankly. The rates are good, the tenor of the loans are good. So whether it's for the SMEs or the healthcare sector or even the technology sector, I think it's been quite a welcoming policy. Now, how widespread and deep that goes is a different story. I know of the agro loan to SMEs and micro enterprises that have been pending for quite a while. You hear some questions about whether or not that program is still on. Whereas the central bank would insist that it's disbursed a certain amount of money, there's a large swath of operators that have not been able to access it. So how, and actually some states have actually, and governors too, have raised questions as to whether or not their regions or their states are being neglected. So targeting the right players with this sort of intervention funds are very useful. It might be an extraordinary step, but within the context of our environment, Nigeria's current situation, I think is a welcome way of stimulating and truly catalyzing growth in manufacturing, in technology, in the agro sector, and healthcare.
All right, thank you so much for that. Mohamed, if you can speak to this point, your expectations for the macro indices, so to speak, inflation and interest rates moving forward. Gregory earlier mentioned that he expects that the MPC will continue to keep the rate unchanged, at least for the foreseeable future. Now, if that happens, what are your expectations?
Yes, I would be more inclined to believe that probably rates will remain, on hold. There's obviously the tension between the high inflation versus the bit of a slow recovery so far. I guess it's this dynamic won't change. I mean, at least on the growth side, until we see maybe a pickup in much bigger pickup in global growth, but also improvement in maybe vaccination rates also in Nigeria, just to allow opening up of the economy and resume travel and so on. So I guess that will take a while, and maybe at least until the end of this year, if not going into well into next year. So I think in that environment, it's probably maybe waiting for inflation to slow down a little bit from here, depending obviously on improvement in the security situation. I think that the one thing I would be looking forward to is just really a bit of an improvement in the FX environment, because also this has to be a good catalyst for growth. So maybe I'd be looking forward to for the upcoming Eurobond issuance. Also, I totally agree with Greg that this the talk about the diaspora kind of bond is very interesting. I mean, if this also can happen within the next I don't know, until the end of the year, early next year, I think that also could provide some additional stream, foreign currency, together with where oil prices are right now, that could start to ease, the FX environment more, and I think that's key for, supporting the recovery.